Hello, everyone. It's my pleasure to welcome you to the Carbon Direct COP26 Global Forum on Carbon Management Technology and the Race to Zero, the road from COP26. This is a continuation of Carbon Direct's ongoing discussion series taking place around major climate conferences and building on the success of a roundtable during New York Climate Week back in September. My name is Joy Williams, and I'm honored to be moderating this event today. We have a great panel who will be exploring what the rise of this technology means for investors in particular. Now, in my own climate change career, which is longer than I care to admit, I remember one of my very first projects was an afforestation reforestation project. And it was my very first business trip as a new grad, and I had to travel to Georgia in December. I thought, that sounds good, right? Southern state. Then I found out it was the former Republic of Georgia, not the state of Georgia, that I was being asked to go to. So the topic of carbon removals has come a long way from when I stood in a barren, pretty chilly field in the middle of December. This was obviously before the reforestation had taken place. And we were talking about a really niche area of venture capital. In fact, today I'm full-time climate strategist at a climate-focused technology firm called Manifest Climate, where we manage climate risk and building resilience to climate change by leveraging the power of technology. I have over 20 years in climate change, with the last 10 or more in the finance industry, and currently I'm seconded to the high-level champions team of the Marrakesh Partnership of the UNFCCC. My remarks today are my own, but all of this is to say that the topic of climate change and carbon management is now a mainstream discussion, and I'm really looking forward to what our panelists have to say today. Just a couple of housekeeping notes before we begin. This session is being recorded, and in fact, the recording will be on YouTube, as many of you are joining us through that channel. We're going to have a keynote and then a moderated panel, and after the panel discussion, there will be a Q&A. So please do think of great questions for our panelists. There are a few different ways to submit questions if you haven't already done so during your registration process. You can submit questions via the chat available to you on YouTube and Twitter, where this event is being streamed live. And you're also welcome to submit questions via email or text message. That information will be on the screen throughout the event, so please keep an eye out for that. There it is right now. Okay, so on to the main event. The science is quite clear that the current level of pledges and commitments from both nations and private institutions is simply not enough to keep us on track for the Paris Agreement. The scale of that challenge is quite significant, and carbon management technologies have a role to play in keeping global warming to 1.5 degrees. Today, we're here to discuss the investability of carbon management technologies in the context of things like the global regulatory environment, the level of information and disclosure that's available to the finance industry, even the avoidance versus removal debate, and more. This event today is taking place as the COP26, the International Climate Conference, is drawing to a close in Glasgow in the next couple of days. And I have to say, in the last week and a half, finance has been center stage like never before. And it's been made very clear that private finance is a necessary player in this fight to climate change. But the question remains then, how and where can finance find those opportunities? And this is the one topic we want to shed some light on with this panel. So we're going to actually start with a keynote. And the keynote will set the context for this topic, this new and growing area. So it's my pleasure to introduce our keynote speaker and panel contributor, Jonathan Goldberg. Jonathan is the founder and CEO of Carbon Direct. There he is. Carbon Direct has two distinct business areas. On the client-facing side, the firm has an advisory business with a growing clientele of Fortune 100 and 500 clients. This business helps to grow the demand for carbon removals, meet decarbonization goals, and broadly speaking, work on supply chain decarbonization. There is also an investment business, which focuses on investing directly with companies who are scaling carbon removal and management technologies. Both sides of the business are supported by a core team of more than 30 PhD scientists with world-leading expertise in carbon removal. And I love this idea that science is driving what we do. Jonathan has over 15 years of experience in energy investing and project finance since graduating with honors from Yale University with a degree in economics. Prior to launching Carbon Direct, he founded and launched BBL Commodities, Commodity Hedge Fund, where he was the chief investment officer, and he has served as a partner at Glencore previously. His expertise and interest in climate change and carbon management informs his role at Columbia University, where he sits on the board of the Center on Global Energy Policy, and also serves as a lecturer on energy issues, helping steer their carbon dioxide management program, in addition to his role as an advisor to the Lawrence Livermore National Labs report on negative emissions. So, Jonathan, really great. Looking forward to hearing what you have to say, and I'd love to pass the mic over to you for your keynote.
Joy, thank you very much for the generous introduction, and we've got a great group today. So we'll try to keep any remarks here concise because there's a lot to go through. I think it's somewhat self-evident after the last week why this group is assembled today. There's a clear scientific consensus now, not a debate, that to keep global warming to a 2-degree rise and potentially to 1.5 degrees, it's critical to both avoid CO2 emissions from coming into the atmosphere, as well as scaling carbon removal, physically taking CO2 out of the atmosphere. As Joy mentioned, our firm is working on both. The key element of what we're doing as a firm and what we hope to bring to the conversation today are ways that scientific literacy, scientific experience can guide both capital deployment into the space, as well as what companies and even countries should be doing to manage their CO2 footprint. This, for us, involves a number of different pathways, but we do feel it's important to emphasize that none of these pathways, none of the IPCC pathways, really none of the pathways working with clients don't involve significant amounts of both carbon removal and carbon management, not either or, but both. It's also important to emphasize just how large this market needs to be and the scale of the challenge ahead of us. As Joy mentioned, my career before Carbon Direct had been spent in traditional energy investing. And it's almost astonishing to think when you look through carbon management, we need to scale an industry that's twice by volume what's moved in the oil and gas industry every year. And we're starting from a base that is essentially zero. This is a monumental challenge. So we're excited to see all of the momentum from COP, but it's important that we scale that moving forward. And to do that, we need investment, we need science, we need policy, we need corporate action, and they all have to do that, and they all have to do this now. We think that the route forward in carbon management, and we hope to talk about this today, will involve both technology, so technology around CO2 conversion, CO2 utilization, and also carbon removal, things like direct air capture and bioenergy with carbon capture. It also involves significant amounts of nature-based carbon solutions, forestation, soils, et cetera. Once again, it's an approach that involves many different things, not one or the other. And our firm is designed to help across all of those different issues. We're really excited that this message is starting to get across to institutional asset owners and other investment professionals, especially the folks on the call today. It's great to see voluntary carbon markets grow. They've been growing very quickly. However, they're very, very small relative to other asset markets and relative to where they need to be to successfully scale carbon management. It's really important to get buy-in from large institutional asset owners now about structuring a market that everyone can be proud of. I think that it's come up very clearly in both our client work and also what we're hearing out of COP over the last week. I'm sure what many other people on this call have been hearing as well, about just how big the inflection point is that we're at as an industry right now. We've seen tremendous growth in our client base over the last year, and we've been overwhelmed by the announcements, the pledges, the commitments to deploy capital into this field over the last 2 weeks. The key, though, is to take that interest and take those pledges and galvanize it into something that's real, something that's tangible, and something that we can do and scale today. And hopefully we can discuss that over the next hour or so. With that, Joy, I'll turn it back to you, and I'm really looking forward to diving in with the whole group.
Great, thanks, Jonathan. And I think you hit the nail on the head where this has been called the COP of pledges, and we're still looking for the implementation of that. So that gives us a great context to jump into the investability discussion. So moving on, we've convened an expert panel for everyone today. They represent a diverse set of perspectives ranging from investment management, asset ownership, science, emerging markets. And I'm going to do a quick introduction for everyone so that we can then just jump into the conversation. So in addition to Jonathan, who'll be sitting on our panel, we have going in order on the slide, John Scott, Head of Sustainability Risk of Zurich Insurance Group. John has previously held a number of risk positions for Zurich. For the last 10 years, though, he's increasingly focused on global risk, particularly climate change, and his unique experience of industry, such as oil and gas and chemical, as well as numerous government organizations, has given him a deep understanding of the real risks and opportunities of climate change. Next to him, we have Julio Friedman, a senior scientist at Carbon Direct. Julio is a senior research scholar at the Center of Global Energy Policy at Columbia, the CEO of Carbon Wrangler LLC. And Julio, by the way, I love that name, and is a distinguished associate at the Energy Futures Initiative and serves as a special advisor to the Global CCCS Institute. And last but certainly not least, we have James Mwangi, Executive Director of Dalberg Group. He's joining us actually directly from COP, so thank you so much, James, for managing to squeeze us into what I know has been an incredibly busy and chaotic couple of weeks. James established Dalberg's presence in Africa and has previously served as Global Managing Partner and Chief Executive of Dalberg's consulting business. He currently serves as a member of the Global Entrepreneurs Council of the UN Foundation. So those introductions do not do justice to everyone's credentials, but hopefully it gives our audience a little bit of idea of the depth on this panel. So as both Jonathan and I have said, the scale of climate change, the challenge is huge. And climate mitigation, not even talking about adaptation, is a broad subject. But carbon removals is part of this equation. What I always go back to is that science tells us that we need to hit net zero carbon emissions if we want a decent chance of keeping global warming to 1.5 degrees. And I'm going to suggest that, I believe Jonathan has said this as well, that carbon removal is a necessary part of that equation, not even a nice to have. It's like we'll do everything else we have to do, and then we're still going to have carbon removals at the end of the day. So the question here, and I'll turn to Julio first on this one, is how mature is this technology? Like, are we talking about something on someone's drawing board, or is it actually out in the field? Julio, can you sort of set the stage for us, like what is happening out there with this type of technology and where it is in today's world?
Thank you, and I'm more than happy to share some thoughts. Let's start with where you just ended. This is not a nicety, it's a necessity. Zero focuses the mind. We have to get to zero, and that means if you emit anywhere, you must unemit an equal amount. And we don't know how to get the last 10 gigatons. So that's why we're talking about a 10 gigaton a year business. The IPCC has said that to get 1.5 degrees in their report, between 100 billion and a trillion tons of removal by the end of the century. And their most recent update from the Mission Possible people says that by mid-century, we're talking about 200 gigatons. That is a staggering amount of removal that we need in a very short amount of time. And if we fail at anything, we need even more of that. So it's part of the reason this is in the strategy of the United Kingdom, of Saudi Arabia, of the United States and China. In fact, it was called out specifically as part of the US-China Glasgow Joint Agreement. With respect to the technical readiness of this stuff, it's a mixed bag. Some systems were pretty good. So for example, trees, afforestation and reforestation, we know a lot. And in fact, that's where the best supply is today. For some things, we're really good in terms of technical readiness, but they need to be scaled a lot. This is things like direct air capture or bioenergy with CCS or biomass carbon removal and storage, bikers. Some of them need a little more time and a little more science to mature to a point where they can really do the job and commercially deploy. Mineralization, soils fall into that category. And some things are not quite ready for prime time. Ocean alkalinity enhancements, an example of that one. We're not ready to deploy that one at scale. still, we certainly know enough and have enough to move fast and to move now. And we have ideas in terms of where to put X's on the map and get projects going. So at this point, we're not so much limited by technical readiness. We're more limited by capital stocks and by our own imaginations.
Thanks, Julio. And maybe I'll turn back to Jonathan, and just picking up on what Julio said is we know where the X's on the map are. Is this something, Jonathan, that you've seen through the work of Carbon Direct? Can you comment on where those X's might be?
Yeah, so there's a range of projects that are happening now, and I'll start with carbon removal, carbon management being a bit separate. And there's already programs going around. So for example, if you bifurcate things between nature-based solutions and engineered, there's quite a number of large-scale reforestation projects, many of which our clients are involved with. These are great. They're also relatively small relative to the scale of the challenge. On the engineered side, where there's been a lot of focus over the last couple of weeks, there are projects that are actively taking CO2 out of the atmosphere and putting them into the ground. It's very small. We're talking order of magnitude 50,000 tons or fewer that are being taken out of the atmosphere and permanently stored in the ground, in the geosphere, through things like direct air capture, bioenergy with carbon capture, and other purpose-built engineered solutions. That's a start, but it's not much. Those projects are all over the world. There's clusters in Europe, there's clusters in North America. We need to expand the geographies that these projects are in. The technology can work not anywhere, but anywhere with safe storage and infrastructure around it. But the key is, I think, getting to the next generation. So the larger scale facilities, doing offtake agreements for bigger projects at lower cost, getting more available high quality supply into the market. That's where we need to grow very quickly.
So if you're saying that the projects are maybe not up to this right now, up to the size and scale of what we need for the removal, but let's talk about the actual technology. And I think I want to go possibly to John with this. Is this at a stage, what you've heard Jonathan and Julio say, is this at a stage that it's actually ready for investment? Is this something that finance can actually dig its teeth into? Maybe your perspectives on the readiness there.
Yeah, I think it depends on the nature of the technologies that both Julio and Jonathan have talked about. Some are ready to go, as Julio said. Others need some more work on them. And so, quite frankly, some of the investments are going to be sort of more in the early stage investment space, whereas others actually institutional investors can get involved with and have been in the past. I think the real challenges though are about defining what's the efficacy of these different projects, because they all look slightly different. And I think there's a couple of things here to sort of think about. One is about permanence of storage, which technologies and which approaches are going to be the most permanent, because it's no good investing in something that, quite frankly, a forest that goes up in smoke, all your storage has gone up in smoke, and then what do you do about it? Do you have to pay back the money that or that you spent on trying to sequester that carbon dioxide? So lots of questions about permanency, and then I think the other challenge is doing it at a cost, at a price that's acceptable. And I think the other dynamic there has to be around setting a carbon price. And of course, that sounds a very straightforward thing. It's what a lot of investors ask for governments to help support through legislation and regulation and creating markets that work. But the reality is it's a very complicated task. I mean, it's been 6 years since COP21, and we still haven't concluded the negotiations on Article 6. They're going ahead right now. So that's very challenging as well. And that's why the task force for scaling the voluntary carbon markets is so interesting, because that's if it works and that scales in the right way with the right quality projects underpinning it, then that's a way of developing a financing mechanism for these neutralization technologies.
And John, I just want to probe on one thing that you said. There's permanence about forestry, et cetera. Does that lend itself to different types of asset classes for investors? Should there be a particular type of investor that's looking at these, or is there something there for everyone?
No, I think, well, as Julio said, given the different stages of maturity and development of all the technologies, I think we've got to throw a range of different investment approaches and different asset classes to it, from all the way from sort of early stage private equity all the way through to sort of more mature, maybe potentially bond structures. But I think it's a little bit. I made the analogy a little bit with what's been happening in the last 2 years in the world with the pandemic and the incredibly successful development of vaccines. We didn't develop successful vaccines by starting off by saying, oh yeah, we're going to do it with this technology. We took an approach globally which said, okay, we're going to finance and governments are going to support that, a whole range of different technologies, and let's see which ones come out and as winners. And then let's back those to the max. And that's what's happened. And that's why we've been able to create vaccines for a coronavirus at a rate where in prior years it was like a 20-year task. We've done it within a year. Of course, great challenges, and then in the equitable distribution of those vaccines. So I think it's a little bit the same with these kinds of technologies. We shouldn't be just saying, well, this one is going to work now. We've got to invest in a range of them and see which are the most successful. And in a sense, going back to the permanency argument, even if some storage is relatively short term, maybe in the order of a decade or 2 or 3, okay, those carbon dioxide molecules might be back in the atmosphere in 30 years' time, but let's make sure that we at least store them now, and then we can get a chance to get to 1.5 degrees within the next 30 years. So I think it's all fair game, and we've got to get on and do this stuff to, echo Jonathan's initial comments about getting on with it.
Yeah, and that's certainly in line with the stubborn optimism that we adopt as the high-level champions, is get on with it. There's stuff that we can do. But you bring up a good point that I want to bring James in on, and it's this idea of it was a global effort for COVID, and also there's this idea of, equal distribution. And James, from your perspective and your deep expertise on Africa and huge part of the global south, where or how does that play a role in looking for these types of carbon removal technologies and opportunities?
I think it's exactly there. And John, I was nodding along as you pointed out that we nailed the science on the path to a vaccine, and we've completely engaged in self-defeating distribution behavior. Because when you're dealing with a global good, the distribution part is just as important. The variants hit everyone, the impacts hit everywhere. And I think one observation that really stands out is we have this global emergency, we have this carbon removal as a growing area of activity that's required. And we have a huge chunk of the world, particularly the global south, particularly sub-Saharan Africa, where you have idle labor, large amounts of relatively low productive land, huge renewable energy potential, and a real challenge around what industries should this capacity be put to, especially given that COVID has put to a stop the previous surge in economic growth and productivity that much of the continent had experienced. And so there's a question of how do we use that capacity, both to go after the cost of some of these technologies, and some are known, like the nature-based solutions. We should be doing those at the absolute physical limits of speed now, in the places where the market clearing wage is lowest and the market clearing cost of land is lowest. That should be happening right away as fast as possible. But to do that, we then need a price signal that makes sense. And I would argue people immediately think when we say global south that yes, the nature-based solutions are where we start. That is correct, but that is not where we should stop, because the global south is also home to the largest reservoir of untapped renewable energy that has 2 advantages as a source of energy for some of the removal technologies. The first is just the energy intensity per unit of capital is higher. All right, you can magically double the efficiency of a solar panel in Germany by picking it up, putting it on a ship, and putting it in Kenya. You've just doubled its value as a source of energy. So that's one aspect of it. The second aspect is, in highly industrialized countries, renewable energy has a lot of competing uses, including decarbonizing the industrial base that already exists. Whereas in places where that base doesn't exist yet, every unit of investment in renewable energy could wash directly into large volumes of removals, which also have the advantage of not needing to be shipped back out on infrastructure that hasn't been built up to the extent that it has in other parts of the world. So all of a sudden, a number of things that we think of as real barriers to competitiveness in parts of the global south suddenly become advantages, or at least drivers of potential scale in terms of driving us down that cost curve for large scale removals. And my concern is that we will repeat the patterns of the COVID era and not really think about how we get to the places where this could have the biggest impact until it's too late.
And I'm sure, I know from my conversation with the other panelists, they're going to agree with you, James, that there is this huge opportunity, but it has to be thought through properly. So I want to pose this to all four of the panels. I'll call on you one by one to offer the one thing that you would say to the investors listening is, what do they need to do to prepare for this rise in carbon management removal technologies, whether it's nature-based or technology? And maybe we'll go around and have everyone say that one thing that they would want investors to think about. And then in our last 20, 25 minutes, I'd love to then have a discussion with all four of you, and maybe we'll debate pros and cons of what you propose. But let's go in reverse order. I'll start with you, James. What is that one thing then, saying that you've said that there's this big opportunity, but there's been errors in the past about investing in the global south. What is that one thing you would say to investors that they should do to really get ready for this opportunity?
I think we need to crack the question of sending a clear price signal to technology developers across borders, right? The traditional energy industry has done this very well. Once I figure out a new drilling technology, I don't just do it in the country where I developed it. I look for the places in the world that have the geological formations that will give me the biggest yield on that technology, and I get there. And I figure out how to operate there. And that's because there's a consistent pricing signal that says the output from that technology will be valued the same no matter where it is generated once it gets onto the global market. And that's what we need to crack here. I think the economic logic of bringing the global south into play on all of this will become self-evident once people know that actually the cost benefits of doing it in the global south will align with a consistent pricing signal, regardless of where you're doing the intervention.
Okay, so we've got pricing signal that is clear and transparent. I'll go to John next. John, do you have the one piece of advice that you would give investors?
Yeah, I think it's really, I'm going to riff off what James was saying. Totally agree about the pricing, by the way, James. And I think that what goes with the pricing is understanding the quality of the underlying projects and the different technologies. So it's this trade-off between the permanency aspects of the different approaches with all the other benefits that come, which are often not factored into the investment process. But it's all the things you were talking about earlier about the other sustainability benefits of developing these kinds of approaches in different geographies. And I think your points were really well made about the cost competitiveness of the global south. And I think providing job opportunities for people in places where they haven't had jobs or those job opportunities, could be an absolute goldmine for them, and makes such a difference to society more broadly in every other way once people get economic benefits from this kind of technology. So I think those are the things that investors should be thinking about, and especially within the context of the Task Force for Scaling the Voluntary Carbon Markets, those projects that are carbon dioxide removal projects, unlike previous CDM approaches, these have to be real projects that really deliver what we want them to.
And with the types of things you're talking about, John, are things that investors have not done very well in the past. It actually requires a little bit of change in perspective and other understanding to be brought in-house into those investment firms. But we'll come back to that in 1 second. I want to go to Jonathan now. So Jonathan, do you have that one piece of advice for the investors?
Yeah, maybe it's not a singular piece, but I think it goes back a little bit to thinking about potentially mistakes of the past and how to learn from them. And that's just thinking through different types of capital and where you're investing in the spectrum of the development of the technology. So this is an industry that needs early stage financing from venture type capital, from government spending, from R&D perspective. It requires growth equity capital after companies have commercialized to scale sales, development, more projects, more facilities, and then ultimately needs project finance to get large scale carbon removal and carbon management done in physical operations. That capital requires a different type of discipline across the different range of things that it is doing. And I think people need to have very good clarity of thought about, like, how are you investing into what stage of development? What are you looking for? Returns, protections, things of that nature, because it is not a catch-all invest in carbon management. There's one solution for that. There's different types of capital that are needed in different parts of the journey.
And that has also been traditionally a block to a lot of the innovative technology for climate change that has come down the line. So Julio, your piece of advice.
Yeah, well, my first piece of advice is don't listen to anybody who has only one piece of advice. This is a really heterogeneous market, lots of technologies, lots of different supply chains, lots of different operational concerns, lots of different durations, lots of different services, lots of different co-benefits. You're going to have to spend some time and understand the landscape if you're going to get into this. It is going to be the world's biggest market ever by a lot. So it's worth getting into it, but you got to know a little bit and you got to know what you're buying. I often hear people talk about this like it's all one commodity, like it's Brent crude or something. And it's not, I don't think. It's more like multiple commodities, like gold, silver, and copper. It's more like multiple services, like buying and renting and leasing are different services that you pay a different price for different things. They all have value in the market. This is the last thing that I want to get to, is people have to understand not just the cost of these things, they have to understand the price of these things, and then they have to understand the value of these things. And the best value in all carbon removal is its retirement. At the end of the day, if you remove carbon dioxide, you retire that credit. This is not meant to be an eternal market where stuff gets changes. This is meant to be a service that's retired. And in setting that up, you have to imagine that end state. And in that way, it's not a make work program for traders and lawyers. It is going to be a huge, huge, huge market. But the goal of all of this is pulling CO2 out of the atmosphere and retiring it.
So the four of you have just posited four seemingly quite different things that investors need to start to get up to speed on. A lot of this goes to understanding this market better, but also looking at this as in a different way. It doesn't sound like to me that this is your typical long short bet on a stock exchange. So I'm going to open the floor to whoever wants to talk about this. But of these four ideas, we've got the pricing signal that we need to have clear, understanding the quality, the benefits of these projects, not just financial benefits, but lots of other benefits, co-benefits. Understanding that it is different types of capital at different stages and really knowing what you're investing in, and then understanding that this is not one thing. It is a heterogeneous thing. So out of all that, what do you think is going to be the hardest thing, but potentially the most beneficial thing for investors to start on today? Like, what is the thing that they should really get going on today that will really benefit them as the demand for removals starts to rise? I'd like to open the floor to any of the panelists here. Julio, please.
Just super brief. They should not be thinking about buying credits to hit some target this year or even next year. They need to be thinking about building supply. The most scarce resource out there is quality supply. So they should be thinking about how they can start making, investments now that will pay off in 5 years and provide the supply that's necessary. There's other things, but like if I had one wish, it would be that one.
Jonathan, you wanted to add to that?
I think that's well stated. I mean, we all have an urgency to move. I mean, that's how we started this conversation. I do think that there's still education in terms of what makes a good carbon removal, like what is permanence, what is durability, and Joy, you had mentioned in your comments as well. So there's, from the buyer's perspective, there's just diligence and understanding. Why are you doing this, right? Are you doing it to hit some abstract target? Or are you doing it to really manage CO2 from the atmosphere? Getting a handle on that, and then from an investor perspective, kind of a similar vein, I do think security selection is going to remain an incredibly important part of investing into the industry. So tacking cement decarbonization is a really, really important thing. Some companies are going to do it well. Some companies are going to do it poorly. It's not enough to just say from a macro sense. You have to combine that with the science, the technical underwriting, and get the actual security and expression correct.
And James and John, did you have anything to add to this? Kind of what's going to be that game changer for investors?
I think maybe the only observation is doubling down on Julio's point around taking a long view. I think the question you're trying to think about is what's your long-term rich supply of credits out into the market of the latter half of this decade. Getting that rich supply involves decisions today. But as Julio very aptly put it, if you optimize for your returns on the short term, a lot of things that would translate into substantial streams of supply in the second half of the decade and beyond will take longer to develop than they otherwise would have.
Yeah, and I think another angle on this is that with what we've been talking about a lot so far is kind of like people trying to remove the carbon they've already put in the atmosphere, either historically or related to their current emissions. And in a way, that gives the whole activity a bit of a bad name, because if that stops people from doing what they really need to be doing in the next decade, which is abating at source in their own value chains the emissions that they're doing, either by efficiencies or changing the actual methods by which they deliver the services they're delivering to different economies, and that has to be the focus. And in fact, I'd recommend anyone to have a look at the paper that the Net Zero Asset Owners Alliance produced. We talked about actually with a couple of people on this panel back on New York Climate Week. But that paper, the net, what is the net in net zero, is what we called it, and it was a focus on all the different ways that you could deploy to get to net zero. So abatement, compensation, and neutralization. And I think at some point in this journey, I think, Julio, James, and Jonathan are exactly right. We've got to scale these markets and scale these technologies quickly. And that's the investment opportunity. And, if we do it, there'll be some investors who'll make a lot of money out of this as these markets get to the giant scale that Julio was talking about. But at some point, and I don't know when that is, governments are going to have to start thinking about how they're going to fund the removal of carbon dioxide from the atmosphere. And that's a different mechanism. That may be some kind of securitization or bond structure, or it might be just straightforward a tax or a levy that citizens will end up paying to actually remove carbon dioxide from the atmosphere. But first and foremost, let's get these technologies going, and I think that's the opportunity for private investors.
So much to follow up on. I want to follow up on one thing, and then we're getting questions in, so I'll be going to questions shortly. Please do send your questions in if you haven't already. But what all of you are talking about, with my experience in finance, financial professionals are not generally trained on these types of things. For example, taking the long-term view, pensions sometimes do it, but not all pensions do. Being able to understand the co-benefits, being able to have that patient capital to scale. So does anyone on the panel have a view in terms of what are the resources that investors are going to need to bring in-house? Is it knowledge? Is it a specialist? How are they going to get their investment teams up to speed to look at these opportunities in the right way? Jonathan, I see you really want to jump in here.
Well, I mean, so it's a good question. I might state it a little bit differently. I do think that having the technical expertise to actually understand what technologies work, what the science says, does this technology that claims to be removing CO2 or reducing CO2, does it work? Does it actually deliver the climate benefits? Are you running, if you're looking at a carbon removal company, are you running a full LCA on it so that you're including the emissions from gas that's powering the machine? So you're not removing carbon from the atmosphere, but increasing it through methane emissions. Like you have to have that expertise to do this investing well. I mean, that's foundational to the work that we do here. I disagree a little bit in terms of I actually think we're at a point, maybe we weren't at this point 5 years ago, but we're at a point now where return expectations for carbon management companies in particular fit well within traditional timeframes. We have a 10-year investment window. We expect to recognize investments more quickly than that, however, because we're looking at things like, for example, in point source carbon capture, where you can capture CO2 at the point of emissions today at a lower price than the regulatory price of carbon, be it 45Q or the EU carbon ETS. And the financial returns from doing that are very, very good. And the people who are adapting this technology, at least the early movers, are doing so because they have a positive financial IRR. It hits all of their corporate underwriting, cost of capital assumptions, and provides pretty good returns now. So I think that might have been true before, that you were just sort of betting on what would over time become a regulatory or commercial market. I don't think that's true today. And then the other thing we would really do think is important to emphasize, and Julio's done a ton of academic work on this as well, within the CO2 utilization space, we think there's a lot, and by a lot, we mean a gigaton, and by a gigaton, that's a lot, of market right now that is addressable at or below sort of a zero green premium. So you can look at CO2 utilization, CO2 conversion in certain areas. Concrete is one, carbon monoxide is another. These are big markets that you can have lower or potentially zero or negative carbon products at the prevailing commercial price. That is a huge opportunity, and there's a number of other industries that aren't there yet, but could be over time. That is very interesting from a relatively near-term investment horizon.
I'd add from if I may, I'd add from a geographic standpoint, and particularly with the Global South, I think a set of voices that need to be here and getting smart on this are the development finance institutions and some of the concessional capital that's more comfortable with taking some of the country risk aspects of bringing some of these other players. I think, Jonathan, you're right that looking at these technologies and interventions in isolation, a lot of them are beginning to make sense. I think a lot of them in the Global South will fall off because of country risk issues, among others. And I think that is where signaling to the set of institutions that are always on the lookout for places where they can take a little bit of a more patient or slightly risk-loving kind of approach to unleash a broader market, having them understand that there is potentially pent-up demand for investment opportunities in this sector could allow for a nice synergy or some blended finance opportunities to kind of get those places up to the starting line.
Julio, you're on mute. There you go.
All right, just very briefly, I want to make sure that I say this at least at some point, in the odd chance that we don't get to it in some other context. Human capital is going to be the scarcest of all resources around this problem. Anybody who's been able to put carbon removal in their resume has already gotten 5 job offers. And we are going to need a lot of people to do this work. And by a lot of people, I don't just mean like experts in trading houses, although they need to be educated, they need boot camps, they need certificates, they need experience, all that sort of stuff. But this is going to be the biggest market ever. We're going to need people on the ground who know how to run a biochar project, who know how to make feedstocks into a pyrolyzer, make biochar and put it in soils. We're going to need people who can run mineralization operations, grinding or injecting CO2 into deep basaltic rocks. We're going to need people who can build and operate direct air capture devices and build the control systems for them. We're going to need people to plant mangroves and make blue carbon along the coast. Like, there is a lot of work out there, but we can't get the supplies going. We can't get the investable projects until we have those people in line too. So there's a bit of a sort of chicken and egg, push me, pull you kind of problem here. Whether I'm optimistic or pessimistic is beside the point. The work looks like that. We got to get on with it and train these people and get the projects on the ground.
Yeah, and I actually kind of want to pick up on something again that John had said earlier. We're getting some questions in on, for example, offsets and buying offsets, because obviously for those of us who have been in this market enough for a long time enough, we remember the CDM and we remember the JI mechanisms from the Kyoto Protocol. I worked quite a number of years in that, and the registration process was pure hell. It was projects would take years and years to be registered, and you might never see the credits. So we're getting kind of questions about how is this different today compared to the mess of the carbon markets that were back in the early 2000s. And I would also put out there, when I'm going to open up the floor to everyone, but I put out there that those net zero commitments, John, that you brought up, that the AOA has come out, and there's so many other net zero initiatives out there, that it's not necessarily about carbon offsets or trading, but it is about those commitments. And I was wondering if the panel has had some thoughts on, is it a different market now that we're going to go into, and that this is going to be driven by the commitments in the science, and therefore the errors of the past may not be quite as relevant today. John, you're on mute. There you go.
Right, you're still there now, right? Okay, so I think you asked the question in the previous round, which I think segues into this, which is there's got to be, you asked what is it that the investment industry needs? What insights do they need? And I think I go back to one of my earlier comments about the quality of these projects. And that's what's different from the CDM. I think so often, obviously CDM didn't work. Otherwise, we wouldn't be, quite such a bad place as we are now. And very many times investors thought they were investing in something that was doing something, and it wasn't. I mean, it was just, it was vapor. It just either didn't exist or it didn't perform in the way it should do. And I think that's what needs to happen with this approach. There needs to be real clarity for investors, and they either have to go to specialist groups like Carbon Direct, or they have to go, develop it themselves in their own in-house teams. This knowledge and understanding about what is it that works. Going back to my points about permanency and all the other sustainability issues related to a project, the other co-benefits, as well as the fundamental cost. I mean, some of these things are still going to be very, very, very expensive. And until there's an escalating carbon price that makes it worthwhile in the way that Julio was explaining earlier, they're just too expensive. No one's going to make any money out of it. So I think the smart money will initially go into locking in investments into projects which are going to generate low-cost carbon removal that's permanent and has also co-benefits. But you need a bunch of expert people to help you identify those. And by the way, we haven't got it yet. It hasn't been created by the TSVCM, but there's probably a requirement for an independent group, which doesn't end up being bureaucratic and creating the delays you said in terms of registration, but has clarity on how you define some of this quality of project.
So can I add just two things quickly?
Yeah, go ahead, Julio, and then I think Jonathan wants to jump in after you.
So one of the things that's changed in the past 20 years is there's no place to hide anymore. The satellite data has gotten really good on forests. The life cycle analysis is getting really good on projects. The people who are in this space are more sophisticated about these kinds of things. It is much harder to put bollocks on the market and expect that you'll succeed. And that will increasingly get squeezed out over time. And we're already starting to see that happening in the context of these people's commitments. Like people have begun already sort of ferreting out some bad stuff. Well, the other thing I'm going to say is actually a bit of a different perspective than John's. There is already now policy out there that is supporting very high activation of carbon removal. And right now it's not quite law, but in the current reconciliation bill, we're looking at direct air capture at $180 a ton. That is on top of the California low carbon fuel standard, which is almost $200 a ton. It's starting to look like real money at this point. We're also going to see a pivot from a voluntary market increasingly into a compliance market. Things like the CORSIA standard are rethinking what constitutes CO2 removal, how it can be used to decarbonize aviation. As those policies come together, those will provide very strong regulatory incentives, not carbon prices, but still internalizing the externalities in a way that can generate the removals and the finance you need for it.
And Jonathan, did you have something to add on this as well?
I think a lot of those points were made. I guess a couple things. One, there is a fundamentally different policy backdrop, as Julio pointed out. It's hard to do something in the absence of a 45Q or an EUTS, for example, in point source carbon capture. If it's free to emit CO2 into the atmosphere, nobody's going to pay you to capture it. So that is a fundamentally different part of the market today. There's more data available. But I mean, just being, very direct, like it is not pre-written that this will go better, right? I mean, there is a risk that we get lock-in of not very good projects, and there are just more of them, and they're just distributed more broadly, right? And that doesn't help. So we think like the next 12 months are just critical. Our team's working on this every day. I know there's other great people working on this as well, to get the guide rails and the frameworks of like what makes sense to buy if you're interested in hitting a net zero commitment. Does it make sense to prioritize the net zero and carbon accounting terms in the near term if there aren't enough good quality credits to buy, or should we focus on getting more supply, growing in the future with long-term offtakes and better projects that are going to come up over time? And I don't know that the story's written on that yet. It's very
so wait
important
and see.
Yeah, or I wouldn't say wait and see. I would say play very actively and try to shape it into something that can be a better market. It's not preordained that it will be.
Okay. And James, I wanted to bring you in here because, I mean, the whole point of the CDM mechanism was to try and get financial flows to developing countries. And against this new policy backdrop and against like the net zero commitments that are driving it, is there still that same drive?
I think the drive is there. I think to Julio's point earlier, the question will be, can we deal with the information asymmetries? And can we get part of what happens is, to the extent that there's a new drive, so much value is appropriated by transaction structuring and verification and so on, that by the time you get to the actual operator, a lot of the cost advantage has dissipated. Whereas what you actually want is to be seeing real returns at the point of the actual operator on the ground, particularly in places that may have an inherent cost advantage that drives them to rapidly scale up. And so that to me is the question: is will we build a really fat kind of set of intermediaries to deal with a whole set of information, non-transparency and asymmetry issues? Or can we leverage new technologies, shifting of capacity for verification and auditing, et cetera, to the countries where this work could happen most efficiently, in such a way that you're actually starting to see decent size and investable returns coming out of there?
Right. And we got a question on the challenges of scaling, which I think you've all pretty much touched on. I think everything you've mentioned here is a challenge to actually getting this up and running. But the second part of that question was how corporates can play a role. And Jonathan, I'll come back to you because I think you started off by saying there was a role along the entire development chain for different types of capitals. But then you also just said play actively and then see what happens. Do you have anything else to add about where corporates, not governments, can play a role in actually scaling this type of technology?
Yeah, I mean, so it depends on the part of the value proposition, right? So for carbon removal, it needs people to buy carbon removal. You need people to spend money to remove CO2 and put it into the atmosphere. There's definitely some of that going on. We've got clients that are doing this, and it's wonderful to see. The size in absolute terms, though, is still pretty small. Yes, like people stepping up to sort of invest and do project finance is definitely helpful. It gets the wheels going a little bit, but fundamentally, carbon removal providers need customers. They need people to pay to put the CO2 into the ground. A customer could be a government. It could be the US government, it could be another government, or it could be a corporate that's voluntarily doing it. But when you have that demand, it's easy to get the financing. It's actually easy to get the equity investment. The tough part is getting the revenue stream. And we're pretty focused on helping there. There's other things, and actually I've been pretty excited about what's come out the last couple of weeks. And there's definitely a lot of work to be done, but like things like offtake agreements from corporates for example, sustainable aviation fuel, right? That currently has a higher price. The price will go down over time. There's also some regulatory support, but getting those offtake is really important for the developers of sustainable aviation fuel, where current supply is really small. We're talking like 6 million gallons a year. We need to scale quickly. The way that they can do that is with these physical offtake agreements. You can envision the same thing with steel. You can envision the same thing with hydrogen. I've actually been really encouraged by what's been announced over the last 2 weeks. We'll see in the implementation, but I thought that's been great. On carbon removal, I think it's very important to see the only way carbon removal will really work at the scale we need it to is for a financial stream of money, of revenue for the companies to sell into.
Does anyone else have anything to? Yeah, Julio, please.
Yeah, just very quick on that. To the respect of the role of corporates, like we're delighted to see a whole bunch of companies getting into this space. We're delighted to see a bunch of them making net zero commitments. If you go to our website, we actually wrote a blog piece called The 7 Stages of Net Zero Commitments. And the sad truth is that a lot of these guys get into a net zero commitment not understanding what that means. And then suddenly they're like, oh my God, I'm on the hook for what? And we sort of lay out those stages there, where stage 1 is exhilaration and your stock price goes up, and stage 4 is despair and you don't know what to do. But there's a way out of this. And the whole point is, if you put your shoulder into it, we know that we can do this. This is all doable. There's nothing in physics, chemistry, or biology that stops us from doing this work. But corporate actors should be clear-eyed about what their commitment means and how they should achieve it. And there are a lot of opportunities for them to make a change in the world if they do that well.
Great. So we're getting a couple questions that kind of lead, if I could group them, to specific examples. So maybe we could get a little bit granular here, and maybe if some of the panelists could share, is there a specific carbon removal technology that you know of, and the type of investing that it needs, like today, and potentially what that means in terms of, is it early stage, that it needs early stage capital to prepare it for institutional capital later? Or I think a couple of you mentioned there are opportunities out there today that can stand, head to head with a typical traditional investment. Could I ask the panelists maybe if you have specific examples? And Julio, I see you've already unmuted yourself, so take it away.
Well, I didn't, but I'm happy to go first.
Oh.
And among other things, the link to the net zero 7 stages that I was just talking about is in the chat for anybody who's online. I think that there are always places where you can pull together the right resource base and make money, where you can find a really good solar and wind resource to run a direct air capture plant, and you can sell it on the California market and make money today. Like, there's a way to get that done. There's a way to get, there's this, I think, this lovely company, Charm Industrial, that I kind of like, that basically just puts biomass in a big Cuisinart and injects it into a soil. and injects into a deep oil well. And that's actually more lucrative for them than trying to turn it into an energy product. Like, that's pretty slick, and they've received some investment and they're sort of scaling up, and like, that's a good thing to do. I think that, again, for other kinds of projects, there's ways to make money on really good forestry scaling today that are absolutely toe-to-toe competitive with anything. And then similarly, there's something that will sell at the same price or lower, which is much worse. And so there's plenty of places to get this done. I think you just have to be a little savvy about not only the technology, but the geography and the current policy that gets you paid. And all of those things are transparent and obvious enough that people can find the good stuff and get it going.
Great. So forestry, for sure, I know is quite mature. You mentioned a few others there as well.
So what is it? We just announced today, Mitsubishi has put together an agreement with Drax to do 16 million tons a year of CO2 removal at their plant. That will require a bunch of government investment. There's going to be a bunch of government support in it. That didn't exist last week, and now it does as a project. So these things are coming forward in this way, and there's opportunities that look like that around the world, and I do mean around the world, that are actionable. And part of the idea is, once people see them, then they can think about how to invest.
Great. Another example. Jonathan, do you have another example you wanted to share?
Yeah, I mean, in carbon management, I don't think the market's caught up to how quickly, frankly, the cost of doing point source carbon capture is moving down the curve, while the revenue opportunities are moving up the curve. So we've had an escalating price for EU ETS for the last year or so. We've had increase for 45Q, or we'll soon be formalized increase for 45Q, and an escalating price in Canada, among other regions. At the same time, you've seen significant investment into point source carbon capture and a decline in cost. And this isn't some sort of niche sector, right? I mean, we're talking about technologies that, through kiln technologies, carbon capture technologies, et cetera, are addressing steel, cement, really, really big parts of the economy. Not an overnight fix, needs massive deployment, needs integration with plants, needs work, needs siting, needs all of those things. But when you're talking about like the core KPIs of the technology relative to the revenue opportunity, it's extremely attractive. I think that's very appropriate now for growth equity capital, because you're getting these plants, projects approved, you're getting sales going. Over time, it's very appropriate for project finance capital. You've de-risked the core technology of it. There's a mid-teens IRR associated with financing the scale up of the project. Those are financeable, actionable carbon management projects.
Great. And then James, I mean, you talked about, you mentioned before that the amount of land and stuff in Africa that is actually available. So I'm wondering, were you thinking of examples in the soil sequestration or the agriculture or perhaps something else?
I think all of the above and more. I think over the last few weeks, as you know, you look at business models like Charm Industrial, really interesting for parts of the continent that produce a lot of biomass, and where the main restriction is market access issues. Well, if we can actually generate value from that biomass immediately and then re-inject it, some of that goes away, and you do have large amounts of land, large amounts of capacity. We're seeing in Iceland with DAC the very strong synergy between geothermal power sources and carbon removal. You've got very active geothermal zones, several times larger than the Icelandic one, all up and down the Great Rift Valley in Africa, often with decent logistics to and fro, and again, a different play there. So really across every space, the thing that to me really stands out once I look at it is two things. One, you have lots of under-tapped or under-leveraged resources, which means that the cost coming in is lower. But secondly, competing uses, and I guess it's two sides of the same coin. There's a lot fewer competing uses as of now. Hopefully, I care about Africa's development. That will change over time. But that delta between what's available and competing uses of it suggests to me that the cost advantages across various factor inputs will be tough to beat for quite a few of the technologies under consideration.
Okay. And John, in your last number of years looking at this, is there a particular example you'd like to share for the audience?
Well, Joy, you asked about where, what were things that are mature now that you can invest in today. I'm pretty that in the carbon removal space, it's things biochar, carbonated building elements or wooden building elements, and this whole thing about geologically stored carbon that the other panelists have spoken about. But actually, my favorite is in the biological space. Obviously, afforestation, reforestation. You mentioned that you started in your career in that kind of thing. But the reality is, forests when they're mature are systems in equilibrium. They're by and large, a mature forest is absorbing and emitting similar amounts of greenhouse gases. That's because of as plants die and they compost and they emit methane and carbon dioxide. So one of the things that I find really exciting is in the context of marginal farmland, especially in the global south, often quite arid. It's land which people have tried to grow crops on and have failed because they haven't had enough irrigation or there's been issues with fertility of the soil. But that's because people have been trying to grow crops which are not indigenous. So I'm really excited by people who are looking at growing indigenous plants, which by and large are resilient to the environment in terms of wildfires and things like that. These are plants where typically the root systems don't die in a forest fire or a fire. The branches and the leaves grow incredibly quickly, like in 2 or 3 years after a fire, they grow back. So that means that kind of plant that's often sort of bush or scrub rather than big trees can be grown deliberately, coppiced regularly, which is kind of like a mass movement business. You're cutting trees and shrubs down, taking them and storing them in saline pits with saline groundwater covered with clay, so that these things, wood and woody material does not compost in that kind of anoxic environment. That means you properly sequestered the carbon dioxide, and that kind of business creates incredible biodiversity benefits, and biodiversity is another angle here which is really important. It creates employment for indigenous people. It has multiple side benefits as well as generating very low cost carbon credits. And that for me, going back to James's point, that's something we can do in many parts of the world, where really typically at the moment there's quite poor communities who need that kind of employment. And it seems to me, I'm really excited by that particular opportunity. I think we have to do all the things, as I mentioned earlier, making the analogy with the vaccine development. it's not that there's a silver bullet here. We got to explore everything. But that for me feels like a really interesting place to put their money, but investors put their money.
Yeah, it's a really exciting area. We've had a question specifically for Julio, but I want to give a heads up to the other panelists. We've also had a question that riffs off of what John is saying about the co-benefits. I'm going to come back to everyone in a minute on how investors can actually start to value some of those co-benefits. In the meantime, while you think about that, Julio, we've had this question for you about the geological sequestration. And the question is, I'll read it out so everyone can see it. Although geoscientific community overwhelmingly agrees that CO2 geological sequestration is safe, there is a concern that it would cause earthquakes, and some earthquakes could be felt by people living in surrounding areas. This takes me back to the fracking argument. Do you think that this could cause public panic and resistance, which could actually force these projects to be shut down? And then therefore should be looking at offshore rather than onshore? Is this something that you can speak to, Julio? Oh, you're on mute.
Let's start with the first part of that question. The geological community overwhelmingly believes that we can do this safely and well. I can't say that enough. And in fact, we've been injecting CO2 underground for 50 years. We've been injecting CO2 underground for climate for 25 years. And this is not really a problem. It is also the case that people will be concerned. And I don't think that this automatically means you move to offshore. I think offshore has a different set of NIMBY busting benefits, but I don't think that the earthquakes are really it. In the United States, moving offshore gets you greater access to the pore volume because you've got only one landowner. But in Canada, nobody seems to be worried about this, and the Crown owns the pore volume. I think fundamentally, what people really want to understand in a project is it going to be managed well? Is there a trusted authority? Is there one neck to grab? And like these are the kinds of things that are really, I think, important in project development. This is fundamentally at its core a management issue. The last thing I'll say on this is in most OECD countries today, there's a very clear regulatory environment for the injecting of CO2. Most people don't even know that. They don't know that the EPA requires you to have an answer to the question that was asked before they'll give you a permit. So understanding these things, I think, helps get people on board. At the end of the day, we're going to succeed with success. When we have 100 of these things around the world, everyone will go, oh, I don't know what I was so worried about. But in the meantime, we have to hold hands. We have to listen to people. We have to understand their concerns, and we have to manage the enterprise.
Great answer. Thanks, Julio. So I'd like to return to the panel and then go back to that heads up that I gave you. We've had this question come in is about discussing pricing impacts of those co-benefits. There is, of course, a task force for nature-based solutions, I think now. I'm not up to date on what they're doing, but I know that they're definitely doing work on it. And this question goes on to say it includes social, water, landfill diversion, pricing impacts based on the geographic origin of these projects. So again, really talking about, can investors take into account some of these things, John, that you've mentioned quite a bit of, and fold that into these decisions? Do we have comments on that in terms of, are investors there yet? Is there still work to be done? And is this one of the ways forward that will drive more scale of these types of projects?
So just very quickly, just to sort of tee off the responses to this, I think the ESG data industry has got a lot to do to get the right sort of data here that's trustworthy, and it's the right sort of data that investors can use to understand these issues. And it's we've had 20 years or more of ESG investing, and really it's only just recently that people have been pointing out that, well, a lot of these ESG data providers, the approaches they take are a little bit opaque, and they're not always similar data, and so it's very difficult to get this information. And then on the Task Force for Nature-Related Financial Disclosures, which is kind of in play right now and is trying to do what the TCFD, the Task Force for Climate-Related Financial Disclosures, did. In other words, it's taking not climate in this case, but nature-based and biodiversity issues, and trying to play that into the language that financiers understand, credit and market risk and so on. That's going to be a great help. But I think you don't have to do too much analysis, actually, to figure out for yourself. If you get into this is my point about the quality of projects and the permanency of the storage, you don't have to do too much work to understand what I was describing earlier, that these things, if they're well cited, well understood, well managed, to Julio's point, there's massive potential, massive benefits, and that's what investors have to think about. It's not rocket science.
Thanks, John. James, you had something to build on that?
Yeah, I agree that the range of co-benefits across these interventions is quite vast. I think the question for investors is really trying to figure out which ones buyers will care about the most, and be willing to pay for. I think there's a lot of attention now going towards some of the ecological co-benefits. I think an interesting stream of co-benefits will be the economic development ones in particular. When I think about some of the questions that particularly European buyers looking at Africa, for example, might be concerned about when you combine the migration, job creation, stability issues, suddenly that becomes another interesting stream, and perhaps one that may get to a financial value quite quickly, because there are resources being set aside exactly for economic development in some of these parts of the world. So it's just another stream to keep an eye on, in addition to the biodiversity and broader health ones. But I think overall, we're just trying to figure out for various pools of buyers, what are they going to value?
And probably how to quantify this as well, so that you can show that you're actually producing the value. Jonathan, you also had, I think, a comment on this. You want to jump in here?
Yeah, I guess maybe starting a little bit with like a not exactly an investor perspective, but a buyer of carbon removal projects perspective. This is an incredible point of focus, and I would say the maybe old paradigm of do no harm isn't good enough. People are looking for, not just do no harm, but is there a way that your project is supporting the local community? If so, how? Ensuring that if you're doing I mentioned direct air capture that might require, say, natural gas, ensuring that you're not just spewing methane into the atmosphere and some other areas. Like, this is important stuff. All of our clients care about this very, very much. So if you're looking to deploy capital into the space, you should know that that your buyers, which is how you're going to get a return on your capital investment from doing this work, care about this issue. It's very important.
Just one quick thing to add about that. First of all, what Jonathan just said is correct. Our customers care about this, so we track it. We look for the co-benefits associated with projects and represent them so that our partners and customers can understand them. But the converse is also true. If you get co-benefits and you don't get carbon removal, you're buying the wrong thing. If you're going to get carbon removal, that is a contract and a service you're paying for. You better get that, because otherwise you're buying a biodiversity project, not a carbon removal project.
Yeah, it's never simple. Okay, we've had this question come in. I'm going to read it out to you because it gets a bit technical, but overall, I think it's asking about regulatory oversight, or some sort of oversight on terms of carbon removals. So credits in general are fragmented. You have LCFS, RINs, different types of state credits. Do you believe there's a need to embrace the OTC market with more oversight for the EPA to have a better knowledge of forward obligation years out on companies' books, speculation versus actual hedging? Who would like to jump in on that one? Jonathan? Yes, please.
Yes, I think is the answer. I don't know that it's solely an EPA issue. I think some of it is SEC and financial regulatory. It's very my experiences in managing hedge funds. I talk with Julio about this a lot. It's always been very odd to me that if one is managing a hedge fund or private equity fund, and you have a return of a certain amount, you have to explicitly state what the return is, and there are real penalties for not doing that correctly. That's also true for publicly traded companies and their accounting statements. But to date, you could sort of say whatever you wanted about carbon, and that was fine. that's really weird, because carbon is way more important than financial returns of most of the funds. There's a massive role for regulators to play, and we'd love to work with them as they get more into the marketplace.
Any comments from any of the other panelists? Okay, so we've had a number of questions or requests on very specific types of technology. I think I'm going to list them all off and then open it up to the panelists if you want to comment on any of these. One, we've had a couple times direct air capture, derived carbon neutral fuels, and is that a way to transition away from fossil fuels? There's a question about direct air capture, carbon capture being more expensive than electrification. So there's questions about viability there, and that's where the carbon pricing might come in. Another one about blue carbon, specifically related to seaweed because it grows quite quickly, which I can attest to. Kelp on the West Coast, I forget the stats, but fastest growing plant material on the planet, I think. And let's just see if there's any other ones. I think those were some of the specific ones that that have been mentioned. Do we have any comments from the panelists on thoughts of any of those?
So let me take. Go ahead, John.
Well, I was just going to say, I just wanted to go back to something I was saying earlier about abatement versus neutralization. So many of these carbon capture technologies, especially the geotechnical ones, are highly appropriate, as Jonathan was saying, for, I think, use the phrase carbon management, but for abatement, taking carbon dioxide from a point source of emission within a value chain of a business and storing it deep in the underground in geological storage. And that has to happen at scale in many industries. It's not an excuse for doing other things, by the way, that can be at a lower cost to reduce the carbon emissions from an industry. But there are some places where it will obviously be very highly appropriate in the so-called hard to decarbonize industries. Once that gets up to a certain scale, the scale benefits of that in terms of the cost of storage go right down. Because often the costs will be reduced because the big capital costs up front may be about building pipelines to reservoirs, actually drilling out the reservoirs, which may be depleted oil and gas reservoirs, empty pore space, in other words, or they may be saline aquifers. But the point is, if that happens at scale, that starts making that access that pore space significantly cheaper. I think it's then that you create these fantastic opportunities for access to that for CDR, for neutralization, whether it's using direct air capture or bikers or any of these other technologies that require deep geological storage. And so I think these two things kind of go hand in hand. So I'm with what Jonathan was saying earlier. You need to get the commercialization of abatement technologies like CCUS in place to get the economics right so that the direct air capture type technologies or bikers can really take off.
Thanks, John.
Let me try to speak to a couple of the specific technologies, Joy. Following what John said, I want to start with the one on electrification. First of all, electrification is not a removal technology, it's a reduction technology. And where it is cost effective to do electrification, you should absolutely do it. Period. Wow. There are some things we cannot electrify, like cement plants. In those cases, something like carbon capture is the way to go. It's very, very, very hard to electrify steel mills. In those cases, maybe something like hydrogen is a better answer. And these are a lot of things that are being explored. But removal is a completely different category. Pulling CO2 out of the air and oceans is not a substitute at all for reduction. And vice versa. We have to do reduction, and then we're still going to have to do removals on top of that. With respect to the different technology baskets, synthetic fuels made from direct air capture, not clear those are going to be cost competitive for most markets or most applications, but we think that in some cases they might be, in particular for aviation, which is very, very hard to decarbonize. For something like kelp, kelp has salt, kelp has water in it. Harvesting and transmuting kelp into stuff is very tough business. But there's a company that I think is interesting, Running Tide, that just wants to grow a bunch of kelp and then sink it. Well, that might be actually a pretty fast way, effective way of removing CO2. So there's all these things that we're exploring, and It is also the case that the technology that we have today is not the technology that we're going to have in 5 or 10 years. As John said, the cost of direct air capture is dropping fast. 10 years ago, people thought the cost was $1,000 a ton. Now the cost is $600 a ton. By 2030, I bet you it'll be less than $200 a ton. At $200 a ton, Goldman Sachs estimates that we can shave $5 trillion a year off the cost of global abatement. That's a pretty good bet. And it doesn't substitute for the rest. It just substitutes for the wicked expensive, wicked hearts.
Maybe one thing I'll pick up on, Julio, just interesting. That arrow from existing industrialization, electrifying that, and then afterwards getting into the removals. It's important to recognize that in interesting ways, in places without a well-developed grid or heavy industry, that arrow can run in reverse, so that you can actually finance or provide the initial base case for developing renewable energy, undeveloped renewable energy on a removals base case that lowers the cost for electrification of industry, and so on and so forth. So you could imagine starting at removals in places where nothing is happening right now, and you have a lot of renewable energy potential.
Like Kenya or Rajasthan or South Africa.
I wasn't naming names because I'd be accused of talking my book, but yes.
Do I need to do the disclaimer that this is not investment advice and what has happened before is not a precursor to what happens next? However, this is a great segue. We've had a question about creating a diversified portfolio. And I think you've all touched on bits and pieces of this. You've got removal, you've got utilization, you've got different technologies, and you've got reductions, et cetera, et cetera. Do you have any comments? Throwing this open, this will probably be our last question given time, but do you have any comments about how to go about creating this diversified portfolio from an investment perspective? Is this a smart thing to do? Is this that long-term capital? Is this hedging the bet? I'll throw it open to the panelists here. Who wants to start?
Well, I mean, first of all, most of our customers want that. The people who come to Carbon Direct often want a diverse portfolio. But even in that case, sometimes they say, well, we really want to focus on technical solutions and technology. In other cases, they say we really want to focus on nature-based solutions. But even within those, there's a lot of diversity across the portfolio, which is appropriate. Overall, just like anything else, a diverse portfolio reduces cost and reduces risk. And we ultimately believe that where the market will end up is with people who want to, do a lot of CO2 removal services. They will end up investing in a diverse portfolio of companies, of solutions, of pathways, of geographies, as a way to manage risk and maximize returns.
Sorry, John, go ahead.
Yeah, I was just going to say, it depends what sort of kind of level you're looking at this. So if you're a big institutional investor, yeah, maybe, CDR is maybe a thing you want to get into and support as much as you can, but it's difficult because of the nature of some of the asset classes you're invested in. And it may be that your existing portfolio reflects quite a deal of carbon intensity. And there it's a lot about really putting the focus and the priority on abatement in those sectors in which you're already invested, and really working hard and engaging with those investee companies to make sure that they have science-based targets, that we're very clear on what their decarbonization strategies are, and they're delivering on them, that it's action, not rhetoric. And that has to be the priority in the next 10 years for most institutional investors. But what we argue in the AOA, the Net and Net Zero paper, is that at the same time, you've got to also focus on these development of CDR, because if you don't do that, they won't develop in time to get us to net zero by 2050. So it's not like an either or, it's and it's just that I think that's a natural diversification in any investor's portfolio.
Yeah, I might bifurcate a little bit. When we're looking at the buyers of carbon removal and what we need for carbon removal to reach long-term, tens of gigatons of scale, a diverse portfolio is required, because we don't have enough of any of these individual things to get to the scale and size that we need to be. I think that's very different, actually, from investing in the space. Investing, I think, will require specific technical expertise in the different verticals in which you are investing if you're looking for a return of capital. For us, that means having dedicated expertise in each of the different things that you're investing in. So for example, the technical expertise in understanding carbon capture is different from, for example, bioenergy, right? There is sometimes overlap in terms of expertise, but it's usually a different team that has to look at these. It's also very different from, say, looking at mobility, there's been a lot of excitement around nuclear recently. It's not clear to me that investing in, say, carbon capture gives one any particular expertise in investing in nuclear fusion. They're very, very different things. So I think it's important to treat that with some technical humility, I guess, in terms of understanding each of the different verticals to invest in.
James, last word to you on this.
Somewhat predictably, the one lens of diversification that I think will also earn a reward is really understanding how different geographic applications will play out. So I think that each technology will require a particular skill, but then also I think that there will be a niche for those who figure out how to deploy capital with these technologies in less tapped or less competed for markets.
Great, thank you. So we are practically at time. I'm going to try and do a really quick summary because we've heard so much today in this last hour and a half. But essentially, what we're entering into is a different different atmosphere than when we have looked at carbon offsets, carbon removals in the past. We're being driven by science now. We have a different regulatory atmosphere. We've got the net zero commitments, both from countries as well as from private organizations. And also, one of the things that I want to highlight, because this has happened throughout climate change, is that when we talk about a topic like this, it is not a homogeneous topic. It's actually quite heterogeneous. And you've heard all of our panelists say that different areas are going to need different expertise or different ways of looking at a particular technology or opportunity. And speaking of the opportunities, we've heard that there are some out there today in carbon removals that are ready, that are investable today. But the way to think about this is to get started now, to nurture it, to be active in it, and get ready for the future. This demand is going to rise quite quickly. Prices are also coming down quite quickly. And that opportunity, especially in the global south, a different way to think about it is both the availability of the opportunity in the global south, as well as lower potentially entries to market that you don't have in some other areas and that we have seen in other areas of climate change innovation in the north. And what I would end on is saying that the panelists have been very clear that you can't think of carbon removals on its own. There is so much more that we have to do. There is definitely the reductions, but carbon removals is a necessary part of this equation. So it's definitely going to be there. It's definitely going to be needed, and it'd be wise for investors to start to get knowledgeable about the different areas based on their investment strategy and their role in the finance industry. So with that, I would very much like to thank all the panelists today for their time on this. Thank everyone who has logged in on the YouTube, on the Twitter, and thank you to Carbon Direct for hosting this series of discussions. Thank you very much, and I hope you have a great weekend and looking forward to the end of COP.